All right. Good afternoon. You see, when we have guests, we start on time. So we are delighted to be joined by Junhua, who you all know is the Undersecretary General for the Department of Economic and Social Affairs. We also have with us Shantanu Mukherjee, who is DESA's Director of Economic Analysis and Policy Division, and Hamid Rashid, who is the Chief of the Global Economic Monitoring Branch at DESA, and they're here, of course, to launch the latest World Economic Situation Prospects report. USG, please, I leave it to you.
Thank you.
Please, go ahead.
Well, good afternoon, distinguished guests, ladies and gentlemen. Welcome to the launch of the World Economic Situation and Prospect report for 2023, prepared by the United Nations Department of Economic and Social Affairs in partnership with the United Nations Conference on Trade and Development and the 5 UN regional commissions. When the General Assembly called for this annual report 76 years ago, member states asked that it contained an analysis of the major dislocations of the needs and the supplies in the world economy. Such dislocations exist today, but however, in a very unprecedented ways. We are facing a 4th year of a pandemic, a nearly year-long war in Ukraine, and a worsening climate emergency. These overlapping crises have already slowed growth, exacerbated poverty and hunger, threatened energy security, unleashed inflationary pressures, and led to the debt distress. Against this backdrop, the near-term economic outlook is very sobering. Projected global growth in 2023 is the lowest we have seen in the last decade, down to just 1.9%. At the same time, the central banks across the world have raised the interest rates aggressively to tame the decade's high inflation. These interest rate hikes and the rapid tightening of the global financial conditions have weakened the currencies and increased the debt vulnerabilities of many developing countries. We cannot afford monetary over-tightening and potentially self-defeating fiscal austerity. A prolonged period of economic weakness and slowed growth threatens to further undermine the attainments of the SDGs. With this in mind, the report calls on governments and international partners to pursue the more finely calibrated monetary policy frameworks, more judicious public spending, and greater coordination within and across countries. Ladies and gentlemen, without further shocks, things in 2024 were likely to improve a little bit, but it will not be sufficient or enough to put us on tracks to build the economic base needed to achieve the SDGs. We must work together to accelerate the actions needed to create the necessary enabling environment. In this regard, international cooperation is fundamental. Now that I would like to invite my colleague to share the more further details on the report.
Thank you, Mr. Lee. Before we get into a detailed presentation, let me share a few big picture messages and just kind of orient you a bit as to what's in the report. First, as USG has pointed out, this is a gloomy outlook. Global growth in 2023 expected to come in at only 1.9%, and inflation down from its peak across the world, but still relatively high at 6.5%. Second, there is considerable variation here across developed and developing regions. For developing countries, we are looking at an average growth of 3.9%, which is the same as last year's, and inflation at 8.5%. And for least developed countries, these are 4.4% and 16.6% respectively. And for the developed world, these are at 0.4% and 5.2%. Third point I'd like to make is that progress towards the SDGs, which was already slowing since 2019 and set back even further by COVID as well as the war in Ukraine, will continue to be uphill, and unfortunately, the climb will be even harder for some than for others. We've already seen headline projections for extreme poverty and hunger arising from low growth, high prices, and an insufficient employment recovery from several different sources. But let me highlight two different things here today. First, the growing income inequality. Between 2019 and 2021, average incomes for the top 10% actually rose by 1.2%, while that for the lowest 40% fell by 0.5%. So, in fact, the top 10% now earns on average over 42 times what the lowest 40% earns. Disproportionate losses to women's employment in 2020 have not been fully reversed, and so the gap in paid hours worked between women and men remains high. And at the same time, recent studies are showing significant learning losses in math and reading in developing countries, with girls and younger students being worse affected, posing the real possibility of lifetime impacts and permanent scarring of the economy's growth potential. So finally, what are we learning from these difficult times? Let me make three quick points. First, the urgency of taking externalities and international spillovers into account. Almost all countries have been battling to bring down inflation, but unprecedented interest rate increases in developed regions have compounded the inflation, debt, and balance of payment challenges in many developing countries. Second, the importance of balancing short-term unidimensional perspectives against longer-term ones. As countries face pressures to shrink public spending in the short term, they do run the risk of kneecapping themselves by underinvesting in human capital, green energy, and the digital transformation, or even climate resilience, which undermines their own growth and debt sustainability prospects in the longer term. Third, the imperative to revisit current standards. Both in-country policymaking as well as multilateral collaboration were designed for different times and did indeed support a period of great moderation, as it's called, and notable successes in poverty eradication. But right now, it's lower growth, greater uncertainty, and an ever-increasing degree of integration across countries. And this is calling out for a sober reassessment and updating of standard approaches to economic policymaking, keeping in mind that no two countries are the same and there isn't really one size that fits all. The policy recommendations of the report are informed by these perspectives, and I will now pass the mic to Hamid Rashid from my team and the report's lead author for presenting a more detailed picture. Over to you, Hamid.
Thank you, Shantanu. Just to put it mildly, 2023 would be a difficult year for the world economy, as you've already heard. We'll see a sharp deterioration of global growth across the regions, with some notable exception, but growth would fall quite considerably, especially if you look at what the growth rate the world economy experienced right after COVID-19 pandemic in 2021. Growth was in 2021 5.8%, and then it fell to about 3%. We estimate 3% in 2022, but now further deceleration is expected to 1.9% in 2023. And that is, again, further, there are significant downside risks to that outlook. We are quite confident this is our baseline scenario, but there are certain risks that I would highlight in my presentation. So if you look at, in order to understand the growth outlook for 2023, we have to probably revisit what went wrong in 2022. And let me highlight three key drivers of slower growth that we are experiencing. We experienced in 2022 and further deceleration of growth in 2023. First is that major central banks, including the Federal Reserve Bank of the United States, there was an underestimation of inflation risks very early in the year in 2022. The term that we heard was inflation will be transitory. It is not going to last forever. And there was not enough response to the inflation, creeping inflation that we began in the second half of 2021. And that was basically an underestimation because the inflation was significant supply side constraints were there, and that was ignored at that point. A second driver of the growth deceleration is the war in Ukraine that began early last year, and it continues as of today. And the third, my colleague already mentioned, that sharp monetary response to the inflation. Once it was understood by the market participants that this inflation would not be transitory, there was a rapid and very quick monetary tightening in the U.S. By the U.S. Federal Reserve, and you saw that interest rate spiked from 0.25% to 4.25 to 4.5% range within a year, and that is the fastest rate increase that we saw since the early 1980s. And that was not the only central bank. The other central banks followed the U.S. Federal Reserve's lead, and you can see the ECB, Bank of England, and others also raised interest rates. And in the report, we highlight that 85% of the central banks went into rate hikes, and many of them had multiple rate hikes over the year, and that created a significant drag on the global economy. And the main challenge for that rate hikes, they're not synchronized, and that had negative global spillover effects in terms of affecting other countries through exchange rate channels and also through balance of payment channels and debt sustainability risks that we saw. So in 2023, we are seeing a more divergent trend. We expect sharp deterioration of growth in the U.S. and European Union, and this shouldn't come as a surprise because monetary policy tightening has a lag, and we would expect the U.S. economy to grow about 0.4%. European Union economy would even grow even slower than that, probably around 0.2%. A bright spot among the developed economies is Japan. We expect Japan to grow by about 1.5%, which is not a high growth rate, but by the standard of the other developed economies, Japan's growth looks quite promising in that sense. And then you'd see a divergent trend. China's growth would recover from the low level that it experienced in 2022. Growth would pick up to 4.8% from 3% that we saw last year. In developing countries, growth would remain flat. There will be no discernible increase or deceleration of growth. So the question that we have to ask at this stage is that, is the worst behind us, or do we expect more to come, more in the pipeline in 2023 in terms of policy mistakes and policy misalignment? First, good news is that inflation seems to have peaked in the advanced economies. In the U.S., it peaked in June at about 9.1%, and it fell from 9.1 to 6.5% over the last 6 months. European Union, you can see the inflation peaked in October from about 10.6, and it has been declining the last 2 months. So that means the monetary tightening probably can slow down a little bit compared to what we saw in 2022. There can be some reversals in some cases because of inflation pressure would be easing. But then the other side of the coin is that labor market conditions in the developed economies remain very tight. That means central banks may not have a lot of room to abruptly change direction given the tightness in the labor market, low unemployment rate, and partly it's explained by also changes in preferences in the labor market. Many of the workforce that were working before COVID didn't come back, and long COVID is affecting labor force participation rate in the advanced economies. Supply side pressures have eased quite considerably, but is not yet at the pre-pandemic level. So we still would have some supply side pressure that would keep the inflationary pressure high. And in developing countries, what we see that continued pressure on the fiscal space, a limited fiscal space because debt servicing cost has gone up because of higher interest rates, and that would lead to fiscal pressure and pressure to cut back spending. And that may also affect growth. Now, next 3 slides very quickly about the regional outlooks. And if you look at the regions by region, East Asia and South Asia, they seem to be the bright spot in 2023. relatively higher growth, partly because opening up in China will as I mentioned, that will lead to higher growth in China in 2023. India would also have a relatively high growth in 2023 compared to other countries. And so, in contrast, Latin America, among the developing regions, will have a significant slowdown. Growth is expected to about 1.4% in 2023. And that's because of job creation didn't pick up as much in Latin America, given the high level of debt. And also, inflation would continue to remain very high in Latin American and Caribbean region. And in Africa, the key story for Africa is that debt sustainability risks are rising. Many of the countries, their debt service burden has increased significantly from roughly about 4 or 5% of their government revenue to over 12%. And many of the countries, actually over 20%. Some of them have approached 50%, those who have defaulted recently. So debt servicing burden is a significant drag for public spending and for stimulating growth. And Western Asia would see some of the countries would do better than others given the high oil price and high energy prices, but non-oil producing economies in Western Asia, they will also have significant fiscal pressure for fiscal cutbacks, spending cuts. In the other region that of interest for us is the Commonwealth of Independent States and Georgia. There, of course, given the war in Ukraine, we would expect again a contraction in 2023, negative 1% growth. We would expect the Russian economy to shrink further in 2023 and probably will stagnate in the medium term. And some relief would come in terms of higher export revenue from oil and gas to other direction, but that will not, given the oil price is easing, given lower global demand, that also may not be enough boost for the region to grow, come out of the slump that they would have in 2023. And we expect some recovery, especially our recovery projection is excluding Ukraine, about 2.3% in 2024. So the last slide that I would just draw attention to the policy challenges on the macroeconomic side. What can central banks do? What can the governments do to weather the storm? Because this is, again, a big slump in the global economy. The key imperative for everyone in the government and the policy-making circle is to boost aggregate demand in the economy. On the monetary side, there's a significant risk of over-tightening because there's often overshooting of monetary policy, and to bring down inflation to the target level, central bank may continue to tighten, and that would have significant negative effect, and that we see as a downside risk. Global growth can even go down even further if monetary tightening continues. And also not taking into account the spillover effects of monetary tightening in the advanced economies. Capital outflows, when the interest rate on dollar goes up, capital outflows flows out of the developing countries and come back to the U.S., and that creates liquidity shortfall in the developing countries, and that affects investment, that affects growth. So there has to be some consideration of the spillover effects and how to manage those spillover effects. And also, the inflation targets have been extremely rigid in many countries. 77 countries worldwide, they have inflation targets. And rigid inflation target means many of the central banks remain very fixated on bringing down inflation, even it kills growth. So there's a trade-off between growth and inflation, and often central banks, if they want to just bring it to the target to remain credible, they may have a significant negative effect. So we call for more flexible inflation targeting, and also probably raising their inflation targets to some extent where it's applicable. Again, it's a very country-specific. We don't have prescription for all countries, but in general, that is the direction that may help to mitigate, to overcome the challenges. On the fiscal policy side, our one and only message for the global community at this stage is that to avoid fiscal austerity, also known as fiscal consolidation or fiscal adjustment, all of them come, but they have the same impact on growth, because when the domestic demand is very weak, especially on the household side and on the investment side, public spending can play a very important role. And this is not the time to cut public spending. But that doesn't mean that spending can go on forever with high inflation. Spending has to be prioritized and targeted very well. And along this line, we also highlight the importance of targeting investments for stimulating or for accelerating SDG progress, because this is, again, SDG stimulus packages at the country level can play a very important role to make sure the world economy goes on track and goes back on track to achieve the SDGs. Thank you.
Thank you very much. We'll now go to questions. Sherwin Bryce, please.
Good afternoon. Sherwin Bryce, South African Broadcasting. Messrs. Junhua, Mukherjee, Rashid, on behalf of the UN Correspondents Association, thanks for coming to talk with us. You can decide who's best placed to answer this question. Africa, the report says, remains a full 2.4 percentage points below its pre-pandemic projected real output, which contrasts with developed economies which have more than recuperated from their 2020 real output losses. Put that into context for us, particularly given that this is one of the poorest regions in the world, facing the very same unfavorable climate like everybody else.
Maybe have.
Thank you. I think this is a very good question because, as I mentioned during the presentation, that Africa has significant challenges on the domestic front and also on the external front. On the external demand side, a massive slowdown of the European economy and also the U.S. economy would affect Africa's export potential. That would have significant negative effect on Africa's growth potential. On the domestic side, the biggest challenge for many of the African countries they are facing high levels of debt. Many of the debt countries are facing the risk of debt distress and in fact, debt default. And we saw Ghana defaulted. Other countries are also dealing with this prospect of high levels of debt. And that has significant effect on the fiscal space. Higher debt servicing burden because many of the debt, although those debt are denominated on a fixed coupon rate, but variable interest rate kicks in. The higher interest rate means higher debt servicing cost. And that is eating up most of the fiscal space in many of the African countries. Whereas in Europe and North America, countries were able to, on the fiscal side, they could continue to spend more and support economic recovery. Many of the African governments were not able to do the same. They were required to cut back spending. And our call at this stage is that to sustain the spending level and reprioritize some of the spending. Some spending has more multiplier effects in technical terms, higher fiscal multiplier, and targeting those spending would be very helpful in climate change, in building human capacity, health and education, in terms of building rural infrastructure, improving access to finance and other services. All of them can have a strong growth dividend in the short term, but also in the long term. And that can also help these countries accelerate their progress towards the SDGs.
Yes, please, of course. So let me just give you a quick connection to the SDGs here. So back in 2019, even before COVID, even before the war in Ukraine, we had just started to lose momentum on poverty eradication. And our assessments in 2019 showed we would actually miss the poverty eradication target. I think we were going to be about 4% away from the goal. So that was assuming this growth prospects that you quoted a little while ago, even those would have been insufficient. So now this further shortfall for Africa means we are that much further back from even reaching the poverty target.
Thank you very much, Edith Lederer from the Associated Press. I have two questions. You asked rhetorically what can be learned from what happened in 2022. And you said that a sober assessment is needed. Who should be doing this and what kind of outcomes are you looking for? And I also wonder if you could elaborate on the impact of sanctions on the Russian economy and whether you have any information at all on the Ukrainian economy, which obviously has contracted significantly. Thank you.
Hamid, if you want.
I'll take the second question first. We don't issue sanction is not the main focus of this report, so I'll not comment on the sanction side. But in terms of the Russian economic performance, it has performed better than expected during the last year. Three factors I would highlight. One is that Russian economy is fairly large. It's the 11th largest economy in the world. So there's a lot of domestic reconfiguration and readjustment helped Russian economy to find growth from the domestic sources. Second factor is that Russian central bank played a very active role and strengthened, the ruble strengthened significantly, and that helped also adjust the trade balances quite significantly and played a role in basically stabilizing the economic prospect, and also credit channel also improved with stronger ruble in the economy. So domestic economic activities actually were not as disturbed as we initially anticipated. And third factor is that, of course, there's a windfall gain for the Russian economy from higher energy prices that we saw in 2022. So that's overall, Russian economy performed relatively well. When it comes to Ukraine, we see the devastation. The losses are enormous. Construction would be enormous, and we have estimated some of the quoting at other sources. By some estimates, the budgetary shortfall alone would be about 5 billion euros a month, which is quite significant. Reconstruction would require between 350 billion to 500 billion euros. So significant financing need is there. But that would mean that international community and others will have to play a role, because this is a challenge for the economy in the region.
Thank you. Deji, sorry, on the sober assessment, I think, yeah.
Yeah, I can do that. We are basically calling for revisiting the basic assumptions or frameworks under which monetary policy and fiscal policy is designed, keeping in mind that we are not advocating for a rapid transition away. And we are also not saying that there should be the same kind of approach in all countries. Different countries are different places. But we have to recognize that we've moved quite a bit away from the lessons that were learned during the 1970s and 80s, which is when some of these frameworks were put into place. And so some of this reassessment is already there in the academic and policymaking literature. So when we are saying that developed countries should rethink whether the 2% inflation target makes sense for themselves, not for the rest of the world, but just for themselves. This debate is underway, and there are good, there's good substantive arguments being made for it. So we think this has to be a combination of academia, which is cutting-edge research, with the multilateral economic policymaking institutions, member states who are most in a position to talk about these things, central bank governance mechanisms, and of course at the UN we play a convening neutral role to bring all of these ideas and make sure that some of the voices that may not be there in the G7 or the G20 are also represented and get a chance to talk about these things.
Thank you. Deji, and then Pam.
Hi, this is Deji Xu with China Central Television. Two questions. The first one is for Mr. Rashid, and the second one is for whoever feel appropriate to answer. On the China number, because we know this year, this report suggests that China would have 4.8% GDP growth, which is 0.5% higher than what World Bank's outlook said. Do you consider this a positive number, especially in a tough year according to the report? And how would this affect regional economy? My second question is, I asked my second question to Mr. Rashid last year, and still I'm not a guy who's learning economy, so I still need to know this, because in this report you mentioned the fiscal austerity, and you suggest that is not a good thing for economic growth, but yet the inflation is there. How to handle this dilemma? Thank you.
A standard economic view is that every dollar the government spends leads to inflation. But that is debunked, both in the empirical literature, if you look at it, and also in economic theory. In fact, dollars spent by the government can have very different effects depending on what the money is spent on. So what we call for in the report is that some spending can have very high multiplier and can be inflation reducing, especially if the spending is on easing the supply side constraints. And this is what the U.S. Inflation Reduction Act targeted in terms of targeting investment in climate change efforts, and that would lead to much longer term capacity and more resilience to shocks, and that would lead to higher economic growth, and they would not be inflationary. So the message that we want to put forward here is that not all public spending is inflationary, despite what is being told in some understood in some quarters, but this is not always the case. And especially when there's economic downturn, when the demand from the household, spending from the household is very weak, business spending is very low, public spending can play a very important role as a stabilizer and also as an accelerator of economic growth. Your other point about China's economic growth, we have 4 upside for the growth for China in this year, 4.8%. Why do they arrive? And 2 downsides. Upside is that we see that this elimination of the zero COVID policy that would lead to release of pent-up demand. So we should see some pickup in consumer demand, and that would lead to some growth spurt, especially in 2023. Second, unlike in other developing countries, China has maintained a very supportive fiscal stance and also a very supportive monetary stance. On the fiscal side, NDRC, they have basically committed and allocated about 1.5 trillion won in investment projects that will lead to higher economic growth, we believe, and that's roughly about 1.3% of GDP. On the fiscal side, unlike other major central banks, China is the only exception that it lowered rate in August this year. So that is the second. So on the fiscal and monetary side, you can see significant support. The third factor, you would see that China is also, there's given that there's some recovery, with at least some level of growth in Africa, that China's demand, external demand, may also slightly improve, especially within the region and also in Africa, because the region as a whole in East Asia is doing relatively well. That would boost Chinese export to the region as well. And finally, of course, there's some downside risk as well. One is that whether the zero COVID policies reversal, whether there'll be a significant surge in infection, that can be a considerable risk. And the second factor is that still some uncertainty exists in the property market in China. And if those two those two factors remain managed, then we would expect the growth to reach 4.8% or even higher.
So I have follow-up. So your 4.8% is including those downsides or just,
yes, of course. Yeah, this is our baseline scenario. Yeah.
Thank you. Pam?
Thank you. Thank you for the briefing. It's Pamela Falk from CBS News. Part of the question was asked by Deji, but my question is, this is very in-depth. You've gone through all the world economies. What is your assessment of this downturn in terms of, is it at a breaking point? Is this really harsh for characterize more what you see as this report. You said difficult. Is it really bad? And then a side question is, have you consulted with the IMF and the World Bank? Because obviously, as Deji said, it's a little bit of a different assessment. And how much does the downturn of trade, because of COVID, because of conflict, because of Ukraine war, have an impact on what's going on? And therefore, if trade opens up, things get better. Thanks so much.
Okay, I'm going to answer a couple of these pieces, and then maybe my colleagues can turn in. I don't get the sense we're at a breaking point, as you put it, in any kind of way. I mean, the outlook itself is clear. It's not zero or negative growth. It's positive growth. And the prospect for it is getting better. I think also what is important for us to keep in mind, unlike what happened in, let's say, 2008 during the global financial crisis, the financial sector has actually been stress tested following that crisis, and they have put in place different protocols in the bigger countries and even in the smaller ones. So the risk of a big financial catastrophe seems to not be there. Of course, if there is collective default of some kind on sovereign debts, and these are held by too big to fail institutions, there may be other repercussions, but we are not considering that. That seems to be a slightly extreme possibility. The other positive factor is that, there's considerable chance for inflation to go up, but at this point, it is coming down. Not uniformly, because pass-through remains a problem and domestic prices are often slower to come down than international ones. But I would say it's also hopeful that in the big countries that have the strongest monetary policy regimes for bringing inflation down, it has actually started coming down. Because as we just explained and as this report says, the spillover is a major source of distress for many economies across the world. So if in the bigger economies inflation is believed to be under control, and I think reading the latest market signs and the inversion and the inverted yield curve, it does seem the market also believes that inflation is coming under control, even though it may not be at that 2% rate. So these are positive. It means that the pace of the kind of spillovers that we get from high interest rate policy is going to be less marked. But then you did ask a question, I think, about on trade. Yes, IMF and yeah.
In the process of drafting this report, we usually have an expert group meeting, and that's where we bring in our colleagues from the IMF and the World Bank, and we consult. We spend a day or two, going over the numbers, looking at different scenarios. So yes, I would say that but it is exactly the kind of discussion that we have when. We had this expert group meeting in October. We discussed our views on these issues, on austerity, and many other issues. So there are discussions among the agencies, and of course, this report takes those views into account. Yes, and in terms of trade, I think global trade remains a challenge. It actually, since global financial crisis, and if you look at global trade, over the last 10 years. There has been a secular trend of slowing down global trade, especially the last 5 years, before the pandemic. I think that's something that for global economy to go back to, say, pre-2019 or 2018 growth rate, global growth has to recover. Global trade has to recover. And there, again, a reopening of China is a good sign. Easing of the supply side constraints that we had in the ports, in the system, in the shipping lines, and they're all coming down. So we believe that trade would pick up, and that's why our trade numbers for 2024 is 3.2% growth. Global growth, which would be quite an improvement over what we had, what we expect in 2023. So again, part of the drag on global growth in this year is explained by slow global trade. But if trade recovers, global growth will also recover in 2024.
Very helpful.
Good.
Thank you.
Linda to Sam, and then Mario, and then we'll take some questions on screen.
Thank you. I have a question now. I'm certainly not an economist. First off, must say that. But my question has to deal with income inequality. I believe it was said that in developed countries, the top earners saw their incomes increase by about 10%. Is that correct? And that in developing countries, the top earners saw an increase of 40%. And, hearing the 40%, I just wanted to get a clarification of that. And if that's true, what, for example, who are the top 5 or 10 countries where there's been this tremendous increase in income inequality?
I think my statement was a little bit different. So I think we're talking at the global income distribution in what I was referring to, which is if you rank all of the people in the world by their incomes, all of the people in the world, what would it look like? And so the statistics we present is that across the world, if you look at the top 10% income earners, between 29 and 2021, their incomes on average rose by 1.2%. And if you look at the bottom 40% of the income earners, their incomes fell by 0.5%. And so right now, if we look at this income distribution across the entire world and specific countries, we have some figures in our report. Some particular regions, the income distribution is even more unequal than the others. But across the world taken together, the top 10% on average now earns 42 times what the average income is in the bottom 40%. So that's just a huge amount, just in terms of income. And here we are not even talking about wealth, what you own and your stocks and everything else. We're just talking about income.
Thank you. Ibtisam?
Hi, my name is Ibtisam Azim from Al Arabi Al Jadid newspaper. I have first two follow-ups. You talked about that central banks raised the interest rates aggressively. And if we take the US as an example, we see that they plan to continue to raise interest rates until the end of the year or maybe in the next few months. So what is your recommendation? What should be done? Should there be a pause and then waiting a few months? And then the other question is on, you talked about the more flexible inflation target and that maybe the 2% is unrealistic. So which inflation target would be more realistic? And if I may, my question is also about the Arab region, the Arab world, if you could say more to that and different economies and situation there. Thank you.
Last one.
No, I think first of all that we don't have any specific recommendation for the Fed or for any of the central banks, but in general, what we believe that pace can be slightly different. If you look at the European Central Bank, they had 2 or 3 rate hikes compared to the US 7 rate hikes, and still quite significant increases. European Central Bank have 3 policy rates. The rates that increased from negative 0.5 to about 2% by the end of the year. So it's again slower increases over a period of time, and we expect that European Central Bank would continue to raise rates in next year. But Fed rate hikes were far more faster and probably more aggressive. And we expect the rate increases to slow down in 2023, maybe 2 rate hikes. Again, it's anybody's guess. We're not having a point estimate here, but it could be that the Fed would take into account some of the macroeconomic effects, especially on the labor market side, and they may slow down, and we expect them to slow down the rate hikes because that has a significant global spillover effects. In terms of inflation targets, again, we have an extensive discussion in the report. There are a lot of academic views, but also views from within the central banks, even within the U.S. Federal Reserve Board, they are talking about different inflation targets, mostly talking about range that mean that instead of having a 2% point target, between 1.5% and 3% target. So that gives central banks more room to maneuver as opposed to, because often the credibility of central bank is measured in binary terms. Like if the 2% target is missed, therefore central bank is not credible. But if you have a range, then the range can give them still credibility, but not exactly the way that they have to aggressively reach that target. So the last question you have with the Arab region, we see the Arab region as quite a bit of divergence. The oil exporting economies did very well in 2022. Given that the oil price would slightly moderate in 2023, we'll still expect them to, again, register growth, relatively high growth. But non-oil producing, non-oil exporting economies in the region, they will have significant fiscal pressure. There are net food importers. So if food price continues to remain high, that would have a significant challenge for their food insecurity or food security challenges. And also there are also energy importers that also would be affected by that. So for many of the non-oil exporting Arab region countries, fiscal challenges would probably increase in 2023. And navigating those challenges would be critical for them to come out of the woods and land in a better economic footing in 2024.
Yes, please, go ahead.
I think what Hamid pointed out is actually getting at this point that it is important that the expectations firms and individuals have about where inflation that this be kind of managed, because otherwise you can end up bargaining for higher wages because you think prices will rise, and firms and rushing out to buy things because they'll rise in the future, so it becomes kind of self-fulfilling. So a really important role of the central bank is to manage this expectation. And so we are not saying in this report that central banks should, and to be seen as credible in doing so, we're not saying in this report that central banks should abruptly shift away from whatever inflation target they're following, because then the signal it would send to the market that if inflation is too high, the next time too, the central bank may say our target is X, but then will suddenly say, no, it's actually X plus 2. So then the whole problem becomes more complex. So what we are saying is that they should rethink the amount of policy space they actually need to deal with this volatility. Because if you're at 2%, you can only reduce by 2%, and then you're stuck and you have to do unconventional monetary policy. So that's the message, really. And so we are saying that once things are under control, that is a good time to reassess in a forward-looking way what should happen with inflation targets and other policy frameworks.
Thank you. Mario, then we'll take 2 questions on screen, then we'll have to close it. Go ahead, Mario.
Just a couple follow-ups on your warnings about fiscal.
If you could just introduce yourself.
Oh yeah, I'm Mario Villar with EFE, the Spanish news agency. Following up on your warnings about the fiscal and monetary policy, on the monetary side, I know it's not your baseline scenario, but do you still see any risk of a recession if interest rates keep going up? And on the fiscal side, do your recommendations clash in any way with those of the IMF, which is still telling at least a certain number of countries to work on fiscal consolidation? Thank you.
Thank you. So, yes, we don't discuss recession explicitly, but some countries are already in it. It looks like the United Kingdom, we project their growth rate would be negative this year. European Union as a whole, we are expecting a 0.2%, which is very close to zero, and it can go into negative if there's this significant policy surprises in terms of higher than expected rate increases that affects domestic demand, and that can push the economy towards recession. In the U.S. case, we believe the U.S. economy is fairly resilient in terms of withstanding a shock of this size, but our baseline is 0.4%, but that again is not too far from zero or negative economic growth. This is again downside risk is that over tightening that I mentioned in my presentation. If there's somehow the trajectory of inflation coming down from July last year, and every month we see inflation falling in the U.S. to 6.5%. For some unexpected reason, we see a certain increase in inflation in February or March, and then Fed goes back to excessive tightening. There can be, then we can see a significant dent on consumer demand, and that can lead the economy to a recession. But I would say for the U.S. economy, the downside risk for recession is low. In fact, it's likely to be, there could be a surprise that actually growth could be higher than 0.4% that we're expecting right now. So, yes. And your other question was about, sorry.
About austerity, your warnings against austerity and the IMF recommendations to many countries to work on.
I think diversity of opinion is good. We don't always fully align with the views. Our views are slightly more nuanced. And then again, we don't have one size fits all in terms of what countries. Some countries will need to cut spending for sure, but not all countries. So we are not being prescriptive in the sense that all countries will have to keep spending and spending. But targeted spending can have a very important role, and this is where we are probably slightly different from the views where we're not saying that you have to have fiscal consolidation. We don't want the governments to have knee-jerk reaction to inflation. We are saying, okay, inflation is there, but there are some kind of spending that can actually help to bring down inflation and build productive capacity over long term that would not only address current inflation, but also future inflation. Because when you have higher productive capacity, then inflationary pressures from the supply side would be lower in the long term.
Thank you. We'll go to Arul Louis on screen, Indo-Asian News Agency. Arul?
Hi, thanks for taking my call. This is Arul Louis from IANS. I have set of questions interlinked. What do you ascribe India's relative high growth rate? It's sort of a outlier in the sense of being the highest this year. What suggestions do you have for India to keep up the and also increase the rate of growth? And finally, what do you think are the downside risks to India's trajectory? Thank you.
Please.
Thank you. I think India is a bright spot in the world economy right now, and three key factors I would highlight. First is that India's unemployment rate has come down significantly. In the last 4 years, it's actually unemployment rate is lower than what it was in 2017, I believe, or 2016, about 6.4%. And that means the domestic demand has been pretty strong. India's inflation pressure also has eased quite significantly. It's about, we expect about inflation of about 5.5% this year and 5% next year. That means that the central bank would not have to be aggressively go for monetary tightening there. And India, third factor is India also benefited to some extent. Their import bills have been lower, especially energy import cost has been lower than in the previous years. That has also helped India's growth prospect in 2022 and 2023. There are some downside risks, of course, for the growth prospect in the near term. One risk is obviously that higher interest rates that has a spillover effect. That means the debt servicing cost. I think India's debt servicing cost has exceeded 20% of the budget, and that is a significantly high debt servicing cost, and that would probably have some drag on the growth prospect. And second risk for the Indian economy, of course, the global demand, external demand. Given if Europe goes into a very slow growth mode and the US also in a similar situation, India's export to the world economy may suffer a setback. So these are the downside risks for Indian economy. But on the balance, we believe the Indian economy is on a strong footing given the strong domestic demand in the near term. But in terms of what India can do more in terms of reaping more growth in the near term, we expect the growth to actually pick up in 2024 for India. I believe India's growth in 2024, we are projecting at 6.7%, a very high growth related to other G20 member countries. And I think this is a sustainable growth rate for India, given India also has a significant number of people living in poverty. So this would be a great boost. If India can sustain this growth rate in the near term, that would be good for SDGs, good for poverty reduction globally. Thank you.
Thank you. Last question, Iftikhar Ali, Associate Press of Pakistan. Iftikhar, please go ahead.
Steph, can you hear me?
Perfectly.
Thank you very much. My Indian colleague has asked part of my question, but I will speak about the overall, what the report says overall about South Asia, which is that the economic outlook has significantly deteriorated due to high food and energy prices, etc. And it is more challenging for Bangladesh, Pakistan, and Sri Lanka, who have sought IMF. As experts, what would be your recommendation for these countries to come out of this difficult situation?
You can still take it.
I think, as you have rightly pointed out, these three countries have gone to IMF for emergency support. And I think the IMF, as the lender of the last resort, is there basically to help countries when they have balance of payment challenges. So this should not come as a surprise. In fact, the surprise would be if the countries didn't go to the IMF for financial support. Throughout the report, we call for greater international support in this difficult time for the countries, especially countries that are facing significant challenges with debt burden. And this is, again, we call for more meaningful restructuring of debt. I think Sri Lanka is in the process. Pakistan may also, be in that situation where a significant restructuring of debt can create more fiscal space. Because at this level of debt, it might be more prudent and may make more economic sense to reprofile the debt, reschedule the debt external debt burden to open up more fiscal space. And the last point I would make is that with this external support, to make sure this support just doesn't go into consumption, but that go into investment. Investing in productive capacity can be a very important driver of both short-term recovery and long-term resilience and long-term economic growth. Thank you.
I want to thank our guests. Thank you very much for the comprehensive report. We have Paulina, who's going to brief briefly, and then we'll have the DSG. We're going to delay till about 1:10 to give you guys a chance to stretch your legs on what is a very busy day. But thank you to our guests. Thank you.